It's midnight. You're 3 hours deep into a real estate app, and every single listing under $500,000 looks like it survived a small fire. Cracked tile, a kitchen that hasn't been touched since the Clinton administration, and a listing description that calls a house with a leaning porch full of character. Meanwhile, every house that actually looks livable is sitting at $500,000 or more, and you're doing math in your head, trying to figure out if you somehow missed a promotion or if the entire housing market just quietly lost its mind while you weren't looking. It's not you, it's the math. And the math right now is genuinely brutal. So let's actually do it. Not the version where a loan officer tells you what you're approved for, but the version where we figure out who can actually afford a $500,000 house in 2026 without turning the next decade of their life into a slow motion financial panic attack. Because getting approved for a mortgage and being able to comfortably live your life after signing that mortgage are two completely different things, and almost nobody in the process has any incentive to point that out to you. Here's the uncomfortable starting point. In a huge number of American metro areas right now, $500,000 isn't buying a dream home. It's buying an entry-level 3-bedroom, 2-bathroom box with a yard the size of a parking space. That's the going rate for ordinary in places like Denver, Austin, or basically anywhere within reasonable driving distance of a major city. And the median household in America brings in somewhere around $85,000 a year. So we've built a system where a completely typical household is expected to somehow afford a house priced at nearly 6 times their annual income. If that ratio sounds insane, that's because it is. It's just that everyone around you keeps insisting it's normal. Let's start with the down payment, because this is where most people's plans quietly die before they even get to the mortgage part. The traditional guidance is 20% down, which on a $500,000 house is $100,000 in cash. The average American household has a small fraction of that sitting in savings, often closer to $10,000 total. So most buyers aren't just a little short on their down payment, they're tens of thousands of dollars short. And if your plan is simply to save your way there, run the numbers. If you're earning the median income and manage to save an aggressive 10% of your gross pay, which almost nobody actually sustains, you're putting away somewhere around $8,500 a year. At that pace, saving a full 20% down payment takes over a decade, assuming home prices sit completely still, which they will not. So people do the obvious thing. They skip the 20% and put down 5 or 10% instead, which means they now qualify for a shiny new monthly expense called private mortgage insurance, or PMI. This is a fee, typically somewhere between $200 and $400 a month, that exists purely to protect the bank in case you default. You're not insuring your house. You're insuring the lender's risk, and you're the one footing the bill for it every single month. Now, let's build out the actual monthly cost of owning that $500,000 home. Say you scrape together a 10% down payment, roughly $50,000, leaving you with a $450,000 loan. At today's mortgage rates, somewhere in the 6 to 7% range, depending on your credit, your principal and interest payment alone lands around $2,800 a month. And that number is just the beginning. Add property taxes, which vary by location, but commonly run somewhere between $4,000 and $8,000 a year, or roughly $500 a month on the conservative end. Add homeowners insurance, which has climbed significantly in recent years thanks to more frequent extreme weather, putting you somewhere around $300 a month depending on where you live and what kind of natural disaster risk your region carries. Add maintenance, the cost everyone forgets about until the water heater fails at 11 at night on a Sunday. The standard rule of thumb is to budget roughly 1% of your home's value annually for repairs and upkeep, which on a $500,000 house works out to about $400 a month. And don't forget that PMI payment from earlier. another $200 to $300. Add all of that up, and your real monthly cost of owning this house lands somewhere around $4,300 to $4,400. And that's the best case scenario, assuming nothing major breaks and your HOA doesn't hit you with a surprise assessment for repaving the parking lot. Here's where the math gets genuinely unforgiving. Most financial guidance says housing shouldn't eat more than 28% of your gross monthly income. Banks will often approve you as long as your total debt doesn't exceed 43% of income. Work backward from a $4,400 housing payment using the conservative 28% rule, and you need to be earning somewhere around $185,000 a year. Even using the more generous 43% threshold, you still need something like $145,000 to $150,000 annually, and only around 10 to 15% of American households actually earn that much, which means the overwhelming majority of people looking at that $500,000 listing cannot comfortably afford it by any conventional financial standard. That's not an opinion. That's just what the numbers say. So who's actually buying these homes? Some of it is dual high earning households. Some of it is family money quietly covering the down payment. And a lot of it, more than people like to admit, is households stretching themselves so thin that a single job loss or medical bill would be enough to unravel everything. Let's actually walk through what that stretching looks like with real numbers. Take a household earning a combined $160,000 a year, two working professionals, solidly upper middle class on paper. That income sounds comfortable until you run it through taxes. After federal and state taxes, payroll taxes, and a modest retirement contribution, that household is bringing home somewhere around $9,500 a month. Subtract the $4,400 housing payment we calculated earlier, and they're left with about $5,100 for absolutely everything else in their lives. 2 car payments because commuting requires it. That's roughly $800. Insurance on both vehicles, another $250. Gas, because almost nothing near a $500,000 house is walkable, $300 more. Student loan payments, because the degrees that qualified them for these salaries came with a price tag, another $500 to $600. Health insurance premiums their employer doesn't fully cover, $400. Groceries for 2 working adults trying to eat reasonably, $700 or $800. Utilities on a bigger house, another $450. Add that up, and you're left with roughly $1,500 a month for literally everything else. Clothing, entertainment, car repairs, medical co-pays, and any actual savings or retirement contributions beyond the bare minimum. This household is now spending close to 45% of their take-home pay on housing alone, not the recommended 28%, not even a stretched 35%, nearly half. And these aren't reckless people blowing money on luxuries. They're just trying to live in a house the market has told them is completely normal. Here's what that actually feels like day to day. It feels like checking your bank balance before you commit to a grocery run. It feels like telling your kid you'll figure out the school trip fee later because that $35 might be needed if the car makes a weird noise. It feels like lying awake doing mental math about whether new tires can wait another month. It feels like being one unexpected bill away from a real problem permanently. The air conditioning dies in the middle of summer, and that's a repair bill you don't have sitting around, so it goes on a card. Someone taps your bumper, and your deductible alone wipes out whatever cushion you had. And that's the reality for a household earning $160,000 a year. Now imagine the version of this story for a household earning $120,000 or $100,000, or the actual national median of roughly $85,000. At median income, a $500,000 house isn't tight. It isn't a stretch. It's simply not mathematically possible without either significant outside help or taking on a level of financial risk that would make most people uncomfortable. What makes this whole situation especially frustrating is that nobody involved in the transaction is incentivized to tell you any of this. Sellers price homes at whatever comparable properties recently sold for. Lenders approve buyers up to that 43% debt to income ceiling because technically the loan probably won't default in the first year. Real estate agents earn commission on the sale closing, not on your long-term financial well-being. The entire system is built to get you to the closing table, not to make sure you can actually breathe comfortably once you're there. And once you sign, you're locked in. You can't decide 6 months later that this was a mistake and simply walk away without wrecking your credit and losing whatever you put down. So people stay. They stay in houses that quietly drain them, working jobs they've outgrown because they can't risk any disruption to their income, watching their savings shrink, wondering why something that's supposed to feel like achieving the American dream mostly just feels like constant, low-grade dread. Here's the honest version of this. For a large majority of American households, somewhere in the range of 70 to 80%, a $500,000 home simply is not sustainably affordable right now. Not without accepting a level of financial fragility that would have been considered reckless a generation ago. This isn't a story about people failing to budget well enough or not hustling hard enough. This is a story about home prices completely detaching from what people actually earn. Home values have climbed roughly 400% since the early 90s. Median income over that same stretch has grown by a fraction of that. You cannot budget your way out of that gap. You cannot side hustle your way to a 6-figure down payment while rent is already eating 40% of your paycheck. And no amount of discipline changes what the interest rate actually is. What you can do is look at the real numbers before you sign anything. So the decision is actually yours and not just something that happened to you. Maybe that means continuing to rent and investing the difference instead. Maybe it means looking at homes closer to $350,000, even if that comes with a longer commute or a smaller yard. Maybe it simply means acknowledging that buying in your current market at your current income isn't the right move this year, and that's a completely reasonable conclusion to reach. Because here's what almost nobody says out loud. There's no medal for buying a house you can barely afford. There's no version of pride that survives 3 straight years of stress about making the payment. The real question was never whether a lender would approve you for $500,000. The real question is whether owning that house actually makes your life better, or whether it just quietly transfers your paycheck to a bank while you spend your evenings worrying about the roof. If you're looking at a $500,000 house right now, and your household income is meaningfully under $140,000, it's worth genuinely pausing. Not because you're not capable or not disciplined, but because the numbers themselves don't leave much room for error. And a financial decision this large deserves more scrutiny than a mortgage broker's approval letter. Here's what tends to happen when people push forward anyway. The first couple of months feel manageable, tight, but doable. Then month 4 brings a car repair nobody budgeted for, and it goes on a credit card because every dollar was already spoken for. Month 7, the air conditioning fails in the middle of a heat wave, and that gets financed too. Somewhere around month 9, a partner's hours get cut, and suddenly there's a real shortfall every single month with no emergency fund to fall back on because there was never room to build one in the first place. That's what being house poor actually looks like. You technically own a home, though the bank owns most of it for the next 3 decades, and you can't comfortably live in it, maintain it, or enjoy it. Every unplanned expense becomes a genuine crisis. Every decision gets filtered through, whether it puts the mortgage payment at risk. And somewhere along the way, we started treating that constant low-level financial stress as just a normal part of adulthood, instead of what it actually is, a sign that the price and the paycheck were never really compatible in the first place.